everyone, it's Josh from Nobel Trading and from CWR Private Client Group. I just wanted to put a video together for everyone, kind of go over the market, free flow some thoughts. Keep in mind, the audio, the equipment we're using to film everything, I'm still new to this, so we're doing it as we go. I have an editor helping me, so hopefully in the future the quality improves from here. But remember, in the Discord and the links down below, I provide daily market commentary and also mentorship. Make sure you check that out, come join the community, and enjoy the video. So, we're in really high tensions. The current sitting president and his regime are having a lot of issues with polls. They're scored really low, and we're seeing a lot of volatility in the sentiments towards current political events or the science around the vaccines, and that's also being reflected in the markets, not even just domestically but also internationally. Tensions in China. These are things to consider because it affects how well these infrastructure bills can come out and how those do play out and what those could look like, or even if it comes to how we handle future virus variants coming out. These are all make the market uncertain, and that uncertainty leads to the volatility that we see. And VIX right now, because market is live, we're seeing in 27. If we see that it break 30, you might want to get a little worried. But it already is super high. Obviously, SPY's bleeding off. As we can see, 430 keeps marching down. So which brings us to what this current market environment is that exists in this kind of ambiguity. And what we're working with is, well, first of all, long term, it's hard to kind of be bearish, right? Because what's driving these markets up is these passive incremental investments. And that's your Roth IRAs, your 401ks, those drive things up. But the issue is that investors who are seeking passive investment income, okay, these are your bond buyers that want that passive income to come to them. They're struggling right now, and because they can't find any good options for that, and that pushes them to more volatile sources for that passive income, which involves like selling options, like selling calls. So you sell a bunch of calls. Who buys that? The market maker. As the market maker buys those calls, they have to hedge against that delta. And by the way, there is a full diagram in the Discord that covers this that I put together. It's kind of what this looks like. Covers this, so you can always use it as a resource as well. But the market maker has to hedge against that delta. Okay, so they just buy shares, right? Well, they find themselves even more long as they're hedging against the long. Well, the same can occur on the downside. Okay, so when the market goes short, the market maker actually finds themselves more short. And so then you get the dramatic moves. And of course, if you want that, you want that notes, that diagram I put together, it's downloadable in the Discord. But they find themselves more short, so we get more big swings like this. All right, so that's an interesting thing to take note of, because that's the greater market mechanics, right? That's not even a symptom of anything really going on. That's just how the market likes to swing right now. All right, we got 30% of the market right now is retail investors as well. So that swing it's pretty wild. It can be. And so moving past, now we understand what the market is. We're all on the same starting line. I also wanted to talk about, okay, the macro environment, the dollar milkshake theory. Everyone's worried about hyperinflation, and there is a big debate over how that's going and how that's working out or playing out. And part of that is the dollar milkshake theory, which has been, in the short term, kind of playing out. I'll put a link in the bottom of the video about the dollar milkshake theory, but to save time, I'm not going to cover it in detail. But that ends with the financial crisis, pretty bad one, and it's kind of playing out. So it's something to definitely keep in mind of, especially if we start printing money in the future. Now it takes years for that to play out, but understand that it's kind of playing out, and why the value of the dollar hasn't been dropping. And there's still that debate back and forth about how that inflation is going to go, but it is something to be aware of because it is a risk that I don't think a lot of people are paying attention to. So that brings us then to the more like the global market signals. We're also looking at global markets are definitely signaling some sort of recession. You have all this market risk. China's signaling some more black swan events, both in the fact that warships are at our borders and our allies' borders, and if they make a move in Taiwan, that is 100% black swan event. That is war. That is, in my opinion, the ultimate black swan event. If China moves on Taiwan, game over. Reset, because that's going to be bad. That'll be a whole nother can of worms. We'll get to it if it comes. But the other issue is that Chinese real estate, the Evergrande situation. Remember that Evergrande is only, it's 2% of China's GDP, first of all. Massive debt. It's like over 600 billion yuan, or yuan, rather. I just butchered that 3 times in a row. But it's like $90 billion US dollars of debt. And so, whether that could affect us internationally on its own is debatable. I hear some back and forth on that. But it being still a red flag of greater issues in China definitely seems to be the nail in the head, because it's not the only company that's having trouble paying its bills. It's just the first one to not be able to pay them at all. So, and that's a huge issue. I mean, the government could step in and save, basically force the banks to take bad loans. How does that sound like it's going to go? It's not like that problem's going to go away. It's more of like, how far back will they push it? Same thing that we did when we ran into the 08. It's not the exact same, but it's a rhyme. And so that is another thing that I'm keeping an eye on. And then we have, markets kind of also worried about the Fed not being able to raise, or the Fed reaching the debt ceiling. This is like a cyclical conversation. I'm not really worried about that. They just always raise it. There's no repercussions. There's nothing to suggest that there's immediate repercussions. Although there is fear, and there is fear in the fact that the amount that you're printing could be an issue later into the year, like a big issue. But the thing that really, in the short term, that's got me a little skittish is also that no one seems to be worried about the fact that the Fed could be tapering soon in the next coming months. Now, I don't think that they're anticipating for that to be in September. Month's almost over, though. We're already looking at October when we could see that start to occur. At the same time that there's worries about potential slowdown, and if you look at the bond markets, like the 20 years right here, they're not signaling that the Fed can taper. And this is also what's pushing. I mean, the fact that that return, those yields are so low is what's causing all of this. So the tapering is historically what actually causes a crash, not the actual increase in interest rates. So let me just reiterate that, because I kind of got derailed for a moment. The market historically does not sell off just because of tapering. It sells off when it doesn't sell off because of the increase in interest rates. It sells off because of the tapering. The increase in interest rates historically has actually not led to big sell-offs. It's the tapering that led to, the December 2018. That is what I'm actually a little bit more worried about. I think the market's always looking ahead, and the Fed doesn't even necessarily have to do this in this order. They can just try to push rates up, and then do the tapering. But they're choosing it to do this way. I think they're going to do it this way no matter what, and so you need to be prepared for that. On top of everything else. So you understand, and also understand that if you're just going to try to play the downside, that you're actually paying historically high prices for your puts. And your volatility is high, so those premiums are high. So cash is king right now. finding a safe place to put your money is a good idea. You know, and granted, maybe it melts up. Maybe there is no black swan event. This is the first time I've been a little skittish. You know, I mean, sure, if we plot to this straight here, the COVID crash, then look how much it rallied. You know, you might want to say, well, that's nothing in the greater market rally, because, you know, just buy the dip mentality. But that's not sustainable in perpetuity. And maybe it's just because I'm a younger investor, but I'm hyper aware of what led to people getting blown up in the dot-com bubble, you know? And that kind of brings me, you know, people are also, people are posting in Discord about some more anecdotal information, you know, like bears really seem to have given up. That's something they do at tops. Because most people are wrong, right? So if the bears give up and they're like, whatever, just go up forever, that's actually usually when you see turnaround. And then you're also seeing, you know, euphoric headlines and credit spreads rising, bonds more lowering the ratings, becoming speculative. I'm not just reading off different information that's been shared on the Discord, but it's pretty considerable. It's pretty considerable. I'm still not completely positive on how I want to take my sentiment, other than the fact that I am mostly cash in the day trading account. So I just wanted to make a quick video, just kind of covering the type of risks I see, just to kind of lay that out for everyone so that we're all on the same starting line, and we'll proceed to take things day by day inside the Discord from here. So if you want to check that out, I'll put a link down below to join the Discord. My name's Josh. Thanks for checking out No Bell Trading, and enjoy the rest of your day. And good luck out in those markets.